So, good afternoon, everyone. On the behalf of Auditing and Assurance Standard Board of ICAI, I welcome all the participants at today's webinar on risk assessment and response to assessed risk. In today's webinar, we will cover two important standards, that is SC315, that is identifying and assessing the risk of material misstatement, and SC330, that is on the auditor response to assess risk. For this today, we have CA RS Balaji sir, who will be leading today's session. So good afternoon, Balaji sir. So I would like to introduce our speaker, CA RS Balaji sir. So CA Balaji is a fellow chartered accountant specializing in audit and indirect taxations. He is a certified peer reviewer by the Peer Review Board of ICAI and also has served as a co-opted member of Auditing and Assurance Standard Board of ICAI during 2019 to 21. In addition to his professional practice, he is deeply involved in academics, serving on the Academic Council of Sri Sankara Arts and Science College, Kanchipuram, and as a faculty member of CA students in subjects such as auditing and advanced auditing, and professional ethics and indirect tax also. He has co-author of professional books, including Paduka Company Law Ready Referencer and GST Ready Referencer. CA Balaji sir is a regular speaker at various professional forums, sharing his expertise on topic GST standards on auditing, peer review, and audit quality maturity models. So now I request CA Balaji sir to start this session. So over to you, sir.
Yeah. Very good afternoon, one and all present here, and thanks Vivek Kumar from AASB for your wonderful introduction. Thanks to the AASB for organizing this webinar, which is a knowledge initiative, and also thanks to the tech support team who are actually actively involved in ensuring this particular webinar has been telecasted to all the members here seamlessly. As introduced, today we are going to have some two very important spine-like standards, where without which we may not be in a position to proceed for doing any audit for that matter. So this particular standard is completely mandatory in nature. Usually the standards can be classified into two, those which are applicable and those which are not applicable to a relevant situation. Technically, from my end, for SA315 as well as SA330, always it will be an applicable relevant standard only, because it is considered to be the most important aspect where the members are to be aware about the nuances involved in this particular standard. What are all the standards or requirements? How, as an auditor, I need to satisfy these requirements like that. We need to be aware, and then we need to do a very appropriate audit in this regard. So let me take up this standard one by one, SA315, more into a practical perspective rather than a theoretical perspective. Theory, as the standard says, we need to read verbatim and then we need to go and implement the same. But still, the practicality will be very important for us to implement this particular standard. How, even though there are something technically that is required by a chartered accountant to perform while doing an audit, how it can be implemented, what will be the process, and what will be the documentation requirement for this particular standards, like that my discussions will be more focused towards the practical perspective rather than confining myself on theoretical part only. As the name denotes, SA315, identifying and assessing the risk of material misstatement, which is considered to be a most important technical term. Risk of material misstatement, that's the whole substance of the audit. As an auditor, I need to identify, not only I need to identify, but also I need to assess its impact with regard to the risk of material misstatement. How I need to identify and assess the risk of material misstatement? SA by itself gives that particular manner with which we will be doing it, through understanding the entity and its environment. It is considered to be a bigger one. Lot of technical aspects are also being discussed in this particular essay. So we will go one by one. We will take up important aspects. We will also take up how practically we can implement the same, and then we will try to complete on this. So a brief introduction about the importance. The main discussion during our webinar will be on the standards of SA315 as well as SA330. And if at all any specific questions are there for the participants, at the end, we may be in a position to take based on the availability of the time here. Before venturing into this particular standard, universally, this particular concept has been discussed today, including in IFAC, this particular aspect of audit expectation gap, where as an auditor, we need to identify, first of all, what do you mean by audit expectation gap? As an auditor, how I may be in a position to fill this particular expectation gap. Usually, we may think audit expectation gap is what public thinks auditor will be doing vis-a-vis what actually auditor does, is something called as audit expectation gap. Like that, we may be concluding it, but technically that is not the case. Even IFAC, in an open paper discussion, they have specifically divided this particular audit expectation gap into 3 different components, and then as a result, they identify this as an audit expectation gap. What is this? There are 3 components into it, something like knowledge gap, something on performance gap, and something called the evolution gap. All these 3 put together, you will be identifying something called as audit expectation gap. So what do you mean by knowledge gap? Knowledge gap is exactly the difference between what public thinks the auditor will be doing vis-a-vis what actually auditor is expected to do. Say, for example, being a user of a financial statement, I may think that the auditor will be detecting all the frauds involved in this financial statement. But technically, as per the legal and regulatory requirement, fraud detection is not the responsibility of the auditor at all. So there is a gap with regard to the thought process that the people will be thinking that this will be the duty of the auditor. In fact, that is never the duty of the auditor, something called as knowledge gap. So we need to make ourselves, we need to explicitly come and have an understanding what is the objective of audit, what is the responsibilities of the auditor, and also what is the responsibilities of the management, so that the scope and objective of the audit can be made very, very clear, so that this knowledge gap can be reduced here. The second one is considered to be most important one, attributable to the auditors, performance gap. Exactly, this is what the problem is. What legal and regulatory requirement, including standards on auditing, expects that an auditor to do vis-a-vis what actually auditor does, is something called as performance gap. The auditors do not do what standards on auditing specify or what legal and regulatory requirements impose a responsibility to the auditor. Say, for example, a particular issue has to be dealt in a particular manner, which is as decided by the standards on auditing, or there are specific requirements for the auditor to comply with this, but the auditor, in fact, may not have done this, or I may not have documentation to prove or substantiate that I have done this. So in that particular absence, I may be identified that you have not performed the requirement like that. So it will be attributed towards something called as performance gap. This sort of knowledge emission webinars and more technical discussions will be trying to reduce this particular performance gap, so that we understand what exactly auditors are required to do in a particular situation, how I need to handle, what is the resource that is provided by the standard or legal and regulatory requirement, how the institute guides me to perform a particular activity. Like that, I may be completely aware about the responsibilities of the auditor, and then I will be satisfying those requirements so that the performance gap can be minimized. And the third and very important one is also attributed towards the auditors are something called as evolution gap. The technological inventions and the advancements that is happening, especially in the field of audit, including you have artificial intelligence usage, you have blockchain usage, like that, where we have a lot of advancements that we are in a position to see. So adopting the same and embracing this particular technological advancements into my practical audits will be something on reducing this particular evolution gap. Areas where the audit, where there is a requirement for auditor to upscale and the auditor to go for a revised methodology of performance, where the old primitive methodologies of audit cannot be still performed or may not be valid also in a particular situation here. So technically speaking, we need to try to bridge this knowledge gap, performance gap, and evolution gap, so that the audit expectation gap can be minimized, and even the regulators can vouch for the work that is done by the auditors here. So I feel the performance gap and the evolution gap is having a direct relatable points for this particular standards that today we are going to discuss. Something about SA 315, about identifying and assessing the risk of material misstatement by understanding the entity and its environment, and also SA 330, that is nothing but the responses to the assessed risk. In SA330 is a byproduct of SA315. I actually assess the risk of material misstatement through SA315. The moment I identify and assess the risk of material misstatement, as an auditor, I may be performing the responses to the assessed risk, that is as per SA330 here. So we will take it up one by one and we will understand what are all the basic requirements and what is the specific aspects that I need to look into. This is a snapshot of complete SA315. I thought I can draw your kind attention here. There are certain very important technical terms that we will be discussing in this particular standard. Especially, I have already introduced one particular aspect, risk of material misstatement. What do you mean by risk of material misstatement will be discussed in this particular standard. More importantly, one another aspect, something called as audit risk. The term audit risk is exclusively defined in SA315. What do you mean by audit risk? How the auditor will be in a position to try to reduce that audit risk? Why I need to reduce that audit risk like that? Very many aspects are involved in SA315 specifically relating to audit risk. More importantly, the SA also talks about assertions that are provided by the management and the risk associated relating to the financial statements and also the business risks that are associated in a particular entity, including its environment with which I am going to do an audit. The risk assessment procedures that is to be performed by the auditor. Not only by the auditor, there are certain risk assessment procedures that shall be performed by the management as well. So what are all the risk assessment procedures that should be performed? How as an auditor I need to be evaluating the risk assessments made by the management like that? I will be in a position to discuss the same, including importantly, very typical aspect of understanding the entity's internal controls and its components. The most deliberate part is this particular part, considering the internal controls of an organization. So I am a statutory auditor of a company. Let it be a private limited, let it be a public, let it be a listed, I don't bother. So the moment I am doing a statutory audit of that, will it be the statutory auditor's responsibility to look into the internal controls aspects of the company or not? There is a separate management team which is working on. There are internal auditors also who got appointed. Why I need to do a specific analysis of the internal controls? Because in no point of time as a statutory auditor, I am going to express an opinion on the internal controls of an organization. I'm going to express an opinion on the financial statements of the entity, whether the financial statement reflects true and fair view or not. That's it. So at no point of time, the auditor is going to express an opinion on the internal controls per se. If that being the case, should the statutory auditor understand and analyze the internal controls of the organization? Will it be not the responsibility of the internal auditor? Answer is absolute no. The auditor's responsibility, in spite of the fact that I may be a statutory auditor who is going to express an opinion on the financial statements part of it, still, as an auditor who's going to take care of the complete financial statements, internal control, understanding of the internal control, evaluating the efficiency of the internal controls of an organization shall be a primary responsibility of the statutory auditor. SA315 casts that responsibility to the auditor. So don't get carried away by the misnomer that you are a statutory auditor. You are no longer required to look at the internal perspectives like that. It cannot be a stake that the auditor can claim. I need to necessarily evaluate the internal controls of an organization, understand the complete internal control policies, how that particular policies have been implemented, who have been taken up the responsibility for implementation of those internal controls, whether these internal controls are operating effectively or not. Like that, there are multiple parameters that the auditor has to go and look at and verify, and also needs to document it. Apart from it, section 143(3) reporting responsibilities also includes sorry, I have a bad throat, please excuse me. The Companies Act 143(3) reporting responsibilities of the Companies Act also includes the auditor to comment on the operating efficiencies of the internal financial controls with reference to financial statements. So there are specific requirements for the auditor. Also, even under CARO also, that the auditor has to consider the reports of the internal auditors, and then whether I have taken into consideration the observations made by the internal auditors in my audit, statutory audit, like that, there are multiple factors that will also be tied up here. So these specific aspects are all going to be discussed in this particular SA 315, including there is a possibility of risk assessment and revising that particular risk assessment, specific aspects of documentation, because SA 230 talks about audit documentation is the most fundamental part in every SA. Every SA will be guiding the auditor to perform the audit in an appropriate manner. Not only me performing that in an appropriate manner, documenting the same, that whatever that I have performed will also be an important aspect for the auditor to comply with. So documentation aspects also, what are all the parameters that needs to be specifically documented by the auditor in light of SA 315 will also be a part of our discussion today here. Before entering into the specific requirements of SA 315, this is a beautiful formula that we actually derive from standards on auditing that is to be applied in every audit. 2+3 formula. I always advocate this particular formula. 2+3 formula is equal to compliance of standards on auditing. What is this 2+3 formula? As required by the standards on auditing, specifically as told by SA 200, which is the mother standard for all other standards, there are two constant factors that the auditor has to always have it in mind, and three variable factors that the auditor has also needs to be performed in every audit. There cannot be any alternative at all. Two constant, three variable must be performed. What is this two constant and three variable? Let us go and analyze this specific requirement of SA 200 before we take up anything on SA 315, because I have a point to relate between 200 and 315 here. The formula here is, please understand, the SAs, the standards on auditing, always contain items designed to support the auditor in obtaining a reasonable assurance. As an auditor, the responsibility of the auditor is to provide an assurance, because audit of a financial statement is an assurance engagement. But what is the level of assurance to be provided by the auditor? It is of reasonable assurance to be provided. Technically, as defined by the standards on auditing, what is reasonable assurance? Reasonable assurance is a high but not absolute level of assurance, because absolute level of assurance in auditing can never be achievable. It's not possible. So the maximum level that the auditor can provide is only high level. It's nothing but the reasonable level of assurance that can be provided. The moment I comply with the standards on auditing requirement, they always support the auditor to obtain such reasonable assurance here. In order to perform the audit as per the manner as stipulated by the standards on auditing, the 2+3 has to be followed. 2 constant in any audit, 3 variable that may be changing from entity to entity, organization to organization, based on the complexities and other intricacies that are involved here. The 2 constant factors, as discussed by SAs, are the SAs require that the auditor shall exercise professional judgment and maintain professional skepticism. These are all the 2 constant factors: professional judgment and professional skepticism. What is this professional judgment? It is nothing but making an informed decision. Many items in the auditing involves judgment of the auditor, including determination of materiality. What do you mean by material? In a context of auditing, it is absolutely based on the judgment of the auditor. I certify on truth and fairness. Again, true and fair is based on the judgment of the auditor. Whether it is sufficient, appropriate or not with regard to the audit evidences, again, it is based on the judgment of the auditor. Like that, the judgment plays a very vital role. Judgment of the auditor plays a very vital role in many decision making of the auditor here. So always, as an auditor, I need to exercise that particular professional judgment, which is nothing but making an informed decision in the course of given circumstances based on the context provided by the accounting standards and standards on auditing, as the case may be. This is number 1, professional judgment. The number 2, again, an important constant factor that is always to be maintained, is professional skepticism. That is nothing but an attitude of an auditor which is having a questioning mind. Please understand, I am not suspecting everything. As an auditor, I need to have a questioning mind. Suspicion is different from skepticism here. So I need to have a questioning mind. whether this is sufficient. Is it appropriate? Is it the only audit evidence available? Why not this particular evidence like that? The auditor shall always have that particular sort of questioning mind, the attitude of an auditor having a questioning mind. Being alert to indicators that could indicate possibility of material misstatements through fraud or error. Again, the moment there is a possibility of fraud, there is a possibility of an error. The possibility of material misstatement is identified by the auditor during the normal course of my verification. I should stay alert. I need to go for an extended audit procedure is what the second attitude that is expressed through this professional skepticism. And the third and important attitude of an auditor is critical analysis of my audit evidence, whether is it sufficient and appropriate. Will it be in a position to enable me to form an opinion in order to express that particular opinion or not? Like that, the auditor will always be having a questioning thought process. That is something called as professional skepticism. So professional judgment and professional skepticism are the two constant factors that is to be applied by the auditor in every audit. And the three variable factors as stated by standards are: number one, the first variable factor is the auditor to identify and assess the risk of material misstatement, whether due to fraud or error, based on understanding of the entity and its environment, including the entity's internal control. It is exactly nothing but SA 315. As an auditor, I need to first of all understand the client, understand the entity and its environment. In a very simpler terms, to put it, something called as KYC, know your customer, knowledge about the client's business, is considered to be the most important and elementary aspects without which I may not be in a position to perform that audit at all. Without understanding the entity and without understanding the environment with which my entity operates and the various legal and regulatory requirements which are applicable to that particular entity, I may not be in a position to perform audit at all. So whatever the procedures that you do without this particular basic aspect will be null and void. So technically, the first and foremost aspect that is discussed by SA here is, with regard to a variable factor, is, dear auditor, please understand the entity and its environment. Why I need to understand and its environment, including its internal control? If you understand the entity and its environment, including its internal control, you are in a better position to identify and assess their risk of material misstatement. So what will happen if I identify and assess the risk of material misstatement? Then the second variable comes into play. The moment you identify these are all the possibilities of material misstatements and these are all the effect of such particular material misstatements, immediately I will be performing audit procedures as a responses to that particular assessed risk. That is what the second requirement: obtain sufficient appropriate audit evidence about whether material misstatement exists through designing and implementing appropriate responses to the assessed risk here. My dear professional colleagues, please understand the first and the second requirement are 1 and 2 byproducts here. It is like I'm going to a doctor and say, doctor, I have a stomach pain. Immediately, doctor may not prescribe a medicine, say, for example, based on the veracity, he may prescribe a medicine. After a week, once again, the person goes and complains, sir, I still have the stomach pain. Immediately, the doctor may advise for certain diagnosis. You do this particular testing or you do this particular verification and then bring me the results. That is, doing diagnosis is something on the first variable. I need to perform by understanding the entity and its environment. I need to identify the risk of material misstatement. The moment you identify these are all the possible material misstatements, I need to make the responses to the assessed risk. The doctor will be prescribing medication for that particular problem based on the report that is provided in the diagnosis. He will be making the responses to that particular problem. This is a simple problem, take this medicine, it will be cured. Or this is a problem where we need to go for a treatment for 1 month, have the medicine and then let it be cured. No. This is an important problem where we need to make a surgery, then only it can be solved like that. The responses for the assessed risk will be taken by a doctor, the medicine that will be prescribed by a doctor. Similarly, we, the chartered accountants, the economic doctors of the country, has to identify what could be the problem by understanding the entity and its environment, so that we will be making appropriate responses to the assessed risk, so that I may be in a position to minimize the effect of material misstatements in the financial statements, which could be either through errors or through fraud here. The moment I am in a position to do that, automatically sufficient appropriate audit evidences can be obtained. And the third variable is based on such sufficient and appropriate audit evidences that are available with the auditor, I shall be in a position to form an opinion about the financial statement, and I shall be in a position to express that opinion to the users of the financial statements here. Form an opinion on the financial statements based on the conclusions drawn from the audit evidences that are obtained here. Again, the first variable is exactly as per SA 315. The second variable is as per SA 330, read with 500 series of audit evidences here. Because SA 500 series talks about various audit evidences, the methodology through which audit evidences can be obtained like that. It is a combo of 330 as well as 500 series. And the third variable is 700 series of reporting, including modification in my audit report, a clean report that can be possible, or an emphasis of matter paragraph or other matter to be included, including key audit matter reporting like that. Entire 700 series will be on the forming of opinion and expressing that opinion by way of an audit report here. So to conclude here, the summary of entire discussion about all the standards on auditing will be on 2+3 formula, 2 in the mind, 3 in the fingers, that is 2 constant and 3 variable aspects: professional judgment, professional skepticism. Identify and assess the risk of material misstatement by understanding the entity and its environment, including its internal control. Based on such assessment, perform audit procedures as a responses to the assessed risk so that sufficient appropriate audit evidence can be obtained. And based on the audit evidences that are obtained by the auditor, he shall be in a position to form an opinion and express that opinion by way of an auditor's report here. So to execute it in an implementable fashion, what is the requirement of SA 315? What exactly it talks about? Understanding the entity and its environment, including its internal control. Why I need to do that? To identify and assess the risk of material misstatement. First of all, what do you mean by risk of material misstatement? Why it is happening? And what it will have an effect on the auditor. Like that, we will be going and discussing the specific aspects, including the internal control components, which is considered to be the most important aspect here. Let us venture into SA 315. The objective of SA 315 are 2 in nature. Sir, every standards on auditing will be having certain objectives. So each standards on auditing objectives are to be complied by the auditor. So there will be requirements that will be given in every standard. The moment I am following those requirements, I am satisfying those requirements, automatically the objective of that particular relevant SA can be achieved by the auditor. The moment I am in a position to achieve the relevant standards on auditing's objectives, automatically the overall objective of an audit, that is nothing but to express an appropriate audit opinion, can be achieved by the auditor in a very appropriate manner and in a very sequential fashion here. The objective of this particular SA 315 is to identify and assess the risk of material misstatement, whether due to fraud or error. So frauds and errors are the 2 gateways through which a misstatement can happen. First of all, let us understand what do you mean by misstatement. Misstatement is in a colloquial meaning something called as a mistake. That's misstatement. What should be there and what is there, the difference is something called as misstatement. Say for example, it should be 10 lakhs, but it is stated as 1 lakh. The difference is something called as misstatement. Whether every misstatement is a problem for the auditor? Answer is no. The auditor is not bothered about every misstatement. The auditor is bothered about material misstatements. As per SA 200, read with SA 450, an auditor shall not be responsible for a misstatement which is not material considering financial statement as a whole. Like that, there is one specific guidance is also there. So the point that I am insisting upon is the auditor shall be bothered only about material misstatements. So how to treat a misstatement as a material misstatement? Whether on what basis we need to decide whether a misstatement is a material or not? Again, SA 320 talks about the concept of materiality here. It will be, materiality will be again based on the judgment of the auditor, as we have already discussed. In spite of the fact that it is judgment of the auditor, still SAs define materiality in a different fashion. an item, if its misstatement could influence the economic decisions of the users, will be treated as a material item. A high value item will always be treated as a material item. Cumulative effect of small and insignificant item could also be treated as a material item. Like that, there are multiple factors which describe this particular materiality. So it is again the judgment of the auditor to look at whether a misstatement is a material misstatement or not. If it is so, then I need to go for addressing that particular material misstatement. Technically speaking, misstatement may be because of the two gateways that can create this misstatement, either through error or through fraud. Error is being an unintentional activity. In the normal course of my audit itself, the auditor with due diligence will be in a position to detect these unintentional mistakes, that is nothing but the errors, so that a misstatement which is happening through an error may be predominantly be in a position to be detected by the auditor in the normal course of audit by itself. On the other hand, fraud is an intentional activity where the person who does this particular fraud knows it and he commits in such a fashion that nobody should be in a position to detect it. So it is a carefully laid down scheme. It is a sort of a forgery where it is concealed. And in spite of the fact that I take all reasonable care and caution, the auditor may not be in a position to detect those particular frauds. In spite of the fact that I do my audit as per standards on auditing, the auditor may not be in a position to detect frauds because fraud detection is not the primary responsibility of the auditor. My auditing standards are designed in such a way that I need to perform the audit to obtain reasonable assurance. So fraud detection is not my primary responsibility. That doesn't mean that the auditor will not detect frauds. During the course of my audit, the moment I apply with standards on auditing, including those consideration of SA 240, the auditor could be in a position to detect frauds as well. But that doesn't mean that the auditor will be responsible to detect these frauds. So technically speaking, coming back, the two gateways which can create a misstatement is either through error or through fraud. So the moment errors or fraud is committed, automatically there may be a misstatement. That misstatement could be a material misstatement. If that material misstatement is there in the financial statements, which is signed by the auditor, then it is a problem for the auditor, where I might have not been in a position to detect that material misstatement. I would have signed that the financial statement reflects true and fair view. In fact, because of the material misstatement in the financial statement, the true and fair view could be impaired. The true and fair view could be getting affected. I could have gone for a modified opinion. Instead, I have given a clean opinion, will be resulting in a problem to the auditor. So in order to avoid this, it is important for the auditor to understand the effect of the errors and frauds, consequently the effect of misstatements, consequently the effect of material misstatements, so that I will be in a better position to identify and assess the risk of material misstatement, so that I may be early detecting it or preventing it, or even if it is happening, I may be in a position to remove that from the financial statements by passing adjustment entries and all, will be helping the auditor to go for an appropriate reporting and concluding here. So in order to help that auditor to do that activity, to identify and assess the risk of material misstatement, the most important aspect that the auditor has to do is understand the entity and its environment, including its internal control. Here, internal control's role is very, very essential and crucial. Why? Because if the entity is having effective internal controls, the possibilities of errors and frauds are minimized. That's a very key factor that I keep on insist that the internal controls are to be studied by the auditor and all to be verified by the auditor, because of the fact that if the effective internal controls are implemented by the management and the company is operating in a very efficient manner with regard to those internal controls, the possibilities of errors and the possibilities of frauds are very, very minimal in that particular regard. So the possibility of auditor going wrong is also minimal. So that's the reason that the internal controls are to be identified and assessed, and entities' internal controls, entities' environment has to be identified and assessed, so that the various legal and regulatory framework with which the entity is going to operate, the applicable rules and regulations for which the financial reporting framework would also be there, all will be observed by the auditor and appropriately taken care here. So first requirement objective of this particular essay is to identify and assess the risk of metal misstatement. Not only that, this will help the auditor to reduce the audit risk to an acceptably low level. This is what another very, very important factor. Every standards on auditing talks about this particular aspect, reducing the audit risk. What do you mean by audit risk? What are all the components of these particular audit risk? How the auditor can be in a position to reduce it to an acceptable low level like that. We will be going and discussing about this particular audit risk in a little short while, in a very detailed manner here. There are assertions and business risk. These are all certain technical terms that are also getting discussed in SA 315 here. What do you mean by assertions? Assertions are nothing but the representations from the management here about the correctness and the validity of the transactions and disclosures that are recorded and made in the financial statements here, something called as assertions. And there is also various business risk associated with a particular entity, including its going concern, could be an affect their estimates and judgments that are getting made by the entity, by the management of the entity, including the legal and regulatory challenges that are faced by the entity, the market competitions that are faced by the entity, all will be part of the business risk, which may have an effect on the financial statements and its accounting treatment as well. So the auditor has to understand assertions which are internal in nature, which are provided by the management, and business risks which are external in nature, which the entity may not have controls over this. Sorry, both have effect on the financial statements and the numbers with which I'm going to report. So the auditor has to consider the effect of the assertions and the validity of the assertions that are provided by the management, including the effect of business risk associated while certifying this particular financial statements here. Technically, going further, as discussed in SA 315, there are certain financial statement assertions that are provided by the management. Please understand, these assertions are implied statements that are provided by the management. Explicitly, they don't tell. In spite of the fact they don't tell it explicitly, implied it is deemed that it is all there, like whatever the statements that are provided by the management here. In case of assertions, that's nothing but the implied convictions that are provided by the management, is technically divided into two categories. One is with regard to assets and liabilities, and the other one is with regard to the transactions. The assets and liabilities related assertions were existence, rights and obligations, and valuation. Just an example. I just go with a practical example so that we understand it in a better fashion here. Say, for example, in a balance sheet, in the assets, where you in a company, for a company, you find a buildings worth of 10 crores. The moment you find it in the balance sheet that the buildings of 10 crores PPE, where you have the assertions that are implied, meaning that are conveyed on this particular component by the management, is the existence of that particular building. There is a building that is existing, that's why it is there in my balance sheet. That's why it is there stated as a disclosure in my balance sheet. So existence is an assertion. Fine, existence. The second one is rights and obligation. In case of an asset, it will be a right, and in case of a liability, it will be an obligation. So there will be a rights and obligation. Just a minute, there is some power issue. Please be online. 1 minute, please. Yes, sorry. I think I'm back. I think everything is normal, fine. Thank you. Sorry for the inconvenience caused. There is some power related issue here. I have to change the power source. Fine. Can I continue? Is it okay, tech team? Can I continue? Yes. Thank you. Thank you here. So we are just discussing about a component in a balance sheet of building of 10 crores existence. The management's assertion is building is there. It is there existing. That's why it is there available in my balance sheet. It is an implied statement that is conveyed by the management. Number one, existence. And rights and obligation. In case of an asset, it is my right. In case of a liability, it is my obligation. The company is having a right on that particular asset. I am the owner of that particular asset. That's why it is there available in my balance sheet. So I am having that all legal entities right on this particular asset is an implied statement that is again conveyed by the management here. It is not somebody else's property that I am showing it in my books of accounts. I am having legal title. It is the right of that particular entity. That's why I am having it in my financial statements is what the implied statement that is again conveyed by the management here. Please understand, if you very carefully look at this particular aspect, in case of immovable properties, there is a specific requirement under CARO 2020, whether the title deeds of immovable property are only in the name of the company. If it is not, give a specific reporting why it is not there like that. It is under PPE. There is a specific reporting requirement by the auditor on this particular aspect of rights here. So I want you to try to link this and link with SA 315 in this regard. And the third and very important aspect is valuation of that particular building. As on that particular date, it is valued at 10 crores. Whatever WDV value, it is appropriately valued. It is neither overstated nor understated. It is appropriately stated is what the implied meaning that is conveyed by a single component line item buildings 10 crores. These many meanings are getting conveyed by the management in this regard. As an auditor, how I will be validating these assertions? All these assertions are deemed compliance that is given by the management. But as an auditor, I need to validate whether these assertions are valid or not. So I will be performing audit procedures in this particular regard to validate those assertions. Existence. How I will be in a position to satisfy that there is a building existence. I may be performing an audit procedure of something called physical verification. I'll go to that particular spot, see this particular building. Yes, it is there. I have satisfied by way of my audit procedure. I am satisfied and validated one of the assertion that is provided by the management existence. Yes, it is there. Tick. I document it. Very good. The second assertion, right, company is the owner of this particular building. How I may be in a position to validate it? I will be going for vouching. I will be going for document verification. Please show me the title deed of this particular property. Please show the encumbrance certificate of this particular property. Please show the purchase invoice of this particular property. Like that, I may be in a position to go through documentation and all other audit factors so that I will be satisfying that particular assertion as well. Rights and also obligation in case of a liability. And valuation, whether what is the value, whether this particular value is right, is it a revaluation that is required, what is the book value, whether it has been correctly carried forward or not. Like that, the valuation part can be made by the management either through an expert or through the books of accounts or through the representations made by the management. Like that, I may be in a position to validate all these assertions that are provided by the management here. This is with regard to an asset or a liability. With regard to a transaction, there are multiple assertions again. The transaction related assertions that are provided by the management is occurrence, measurement, completeness in recording, and disclosure of all the above are the again implied meanings conveyed by the management with regard to each and every transactions that is performed by the company in that financial year. That's why you have something called as occurrence. That is, whatever the transactions that are occurred during this particular financial year, 24-25 or 25-26, that particular transaction alone have been captured. It is not the previous year transactions that I am recording it now, or it is not the future transaction next year sales invoice that I am recording it now. I am recording of those transactions which have occurred during this particular relevant period under consideration, which is one of the implied assertion that is provided by the management here, occurrence. That's why the auditor will be performing cutoff procedures to identify what is the first and what is the last number, so that the invoice can be, the sales revenue can be accounted for it, or purchases can be accounted for it, or the provisions can be made for it, like that. It is all relating to that particular assertion called occurrence here. Measurement, that all the transactions have been appropriately measured. Whatever that is to be charged to revenue has been charged to revenue. Whatever that are to be capitalized are to be capitalized. Something like a prepaid has to be accounted appropriately. Something to be classified as an asset. Something has to be classified as my liability. Something has to be classified as my revenue expenses, like that. Whatever the measurement that are to be performed, measurement has to be measurement including the classification that the entity has performed it appropriately, like that. Management is making that assertion, has to be validated by the auditor through the audit procedures here. Completeness in recording, another very important factor, which was again a possibility of material misstatement here. Completeness in recording, nothing got omitted. Whatever the expenses that is to be captured, yes, it has been captured. Whatever the revenue that are to be accounted, yes, it has been accounted. Nothing got omitted, is what completeness in recording. Partially, I have accounted an item that is going to influence my income, and those items which are going to increase my expenses, I have not accounted, like that. It cannot be on a selective basis. Whatever the accounting standards, whatever the accounting financial reporting framework suggests, whatever the legal and regulatory requirement mandates, the same has been completely recorded without omitting any such transaction, is what another assertion that is provided by the management. Not only that, disclosures of all the above wherever required as mandated by the legal and regulatory framework. All these are all financial statement assertions. Please understand, an error or fraud can happen at assertion level or at the disclosures level. At the capturing level itself, there can be an error or a fraud. Say, for example, 10 lakhs rupees of an expenditure has been accounted as 1 crore expenses by adding 1 0. So in this particular guide, maybe the misstatement may be because of error or fraud. So at the assertion level itself, that particular misstatement has happened. Or whatever item has to be disclosed, a particular transaction which is a related party transaction has to be disclosed, but it has not been disclosed. Again, it will be treated as a misstatement only. It could be a material misstatement also. So technically speaking, material misstatement can be at the assertions level or can even be at the financial statement level, which may be on the disclosures and classification part here. The auditor has to consider these particular aspect to understand this sole aspect of audit risk. Very, very important item. I thought I need to draw your complete attention on this particular concept of audit risk. We may be knowing about this particular audit risk, but technically we need to be aware what exactly this particular audit risk is, which is exclusively defined in SA 315. What is audit risk? The possibility of auditor expressing an inappropriate opinion when the financial statement contains material misstatement is something called as audit risk. I repeat, the possibility of auditor expressing an inappropriate opinion when the financial statement contains material misstatement is something called as audit risk. In a colloquial way, audit risk is the possibility of auditor going wrong, is something called as audit risk. I should have gone for a modified opinion because there are material misstatements available in the financial statement, but I have provided a clean opinion stating that the financial statement reflects true and fair view is technically called as audit risk. Auditor has gone wrong. The possibility of auditor expressing an inappropriate opinion. I should have always gone for an appropriate audit opinion, but I have given an inappropriate audit opinion, specifically when the financial statement contains material misstatements. Why the auditor is going for an inappropriate audit opinion? What permits the auditor to go for an inappropriate opinion? Because of three factors, three components of audit risk, three functions of the audit risk. What are all the three components of this particular audit risk? There is something called as inherent risk, something called as control risk, something called as detection risk. This is something technical. I want you to carefully concentrate on this particular part because it's going to be a technical nature. Inherent risk and control risk are also otherwise called as pre-audit risk. In spite of the fact that the auditor entering into the company and doing an audit, this risk is there. Inherent risk and control risk is there. That's why it is called as pre-audit risk. Also more technically called as risk of material misstatement. That is the possibility of material misstatements entering into the financial statements can be through inherent risk or can be through control risk only. Please understand, these are all the two gateways, doors through which the risk of material misstatement can enter into a financial statement. Please understand, errors and frauds are the two gateways through which a misstatement can happen. That particular misstatement, being a material misstatement, entering into the financial statement may be through the gateway of inherent risk or through the gateway of control risk, are the two gateways through which a material misstatement can enter into the financial statement. That's why it is called as risk of material misstatement. Pre-audit risk. The auditor doesn't have any control on this. On the other hand, the third part is something called as detection risk. Detection risk is failure from the auditor's point of view. Auditor unable to detect those material misstatements that are already there in the financial statement is something called as detection risk. Let us understand one by one here. What do you mean by inherent risk? Inherent risk is inbuilt in the nature of the operations and due to the complexities that are involved in the company's financial statements, there are more judgments and estimates and assumptions that are getting made. Because of those estimates, judgments, and assumptions, there are material misstatements that could automatically happen even without the knowledge of the management, something called as inherent risk, inbuilt in the operations. It may not be precisely measured. There are a lot of assumptions that could be involved. Say, for example, in a manufacturing entity where I am a salt producer, salt manufacturing company, where there is a huge salt that is getting produced, my closing stock may not be precisely or accurately measured. It may be based on my estimation. My estimation effect may be materially misstated also. I may be estimating wrongly. So because of which there could be a material misstatement, even management may not know it. Say, for example, I am a crude oil refinery or crude oil manufacturing entity or processing entity where the closing stock of the quantum of the stock I may not be in a position to precisely measure. There are appropriations that are involved. There are estimates and judgments that are involved with which my numbers can be materially misstated as well. Or say, for example, I am a real estate company where the percentage of completion methodology is being applied to value my stock in trade. So the percentage with which I am applying may be erroneous or may be inappropriate, because of which there are material misstatements that could happen in the financial statement of the numbers that are attributed, something called as inherent risk, inbuilt in the operations. Because of the complexities that are involved in the financial statements, there are more estimates and judgments that are being performed, because of which my numbers are relatively wrong. It is something called as inherent risk. Again, inherent risk cannot be reduced, cannot be eliminated. It can be reduced. I may try to implement, but still it is inbuilt, not possible to completely eradicate it. The second, this is one of the gateway through which a material misstatement is happening and entering into the financial statement. The second and most important gateway is something called as control risk. The client's internal control policies and procedures failure to prevent and detect frauds and errors, because of which there are more frauds and errors are happening in the financial statements, something called as control risk. In internal control weakness, internal control failures, lapse in internal controls or lack of controls, all could be attributed towards the control risk. Again, absolutely responsibility is to the management. That's why the auditor has to evaluate whether your internal controls are appropriate or not, so that the frauds and errors are minimized here. If that particular gateway is completely open, there will be a lot of errors and frauds that could enter into the financial statements here, which may be very, very difficult for the auditor to detect it and remove it from the financial statements here. That is something called as control risk. So inherent risk and control risk put together, technically called as risk of material misstatement. And the third component is something called as detection risk, the failure for the auditor to detect that material misstatement, which is already there in the financial statements. Again, it may be divided into two types. One is based on the sample. Because I am verifying based on sample methodology, I am not in a position to detect it. Or because of reasons other than sample, that I may be not be in a position to detect it. Say, for example, my own incompetencies or my team's incompetencies, or they are not enough trained to identify those material misstatements here, or I have not taken all reasonable care and caution in performing that particular audit, or I have not complied with standards on auditing requirements so that I have not applied my audit methodology appropriately. Like that, there are multiple reasons with which the detection risk can also be there triggering to this particular audit risk here. So considering all these three factors, the possibility of auditor expressing an inappropriate opinion is very, very high. The possibility of auditor going wrong is something very, very high. So I need to try to reduce this particular audit risk to an acceptable low level. Actually, audit risk is nothing but the function of all these three particular components here. So the auditor has to try to get that much of sufficient and appropriate audit evidences in such a way that my conclusions are appropriate, my references that are drawn from the audit conclusions that are appropriate, so that the possibility of me providing an appropriate audit opinion is high rather than me providing an inappropriate audit opinion here. So the sufficiency and appropriateness in audit evidences play a very vital role in ensuring that the auditor's audit risk is reduced to an acceptable low level here. Please take it from me. Every standards on auditing talks about this particular aspect of reducing audit risk to an acceptable low level. The ultimate objective is towards this particular process only here. So, as we have discussed with, inherent risk is nothing but there cannot be any related controls at all because of the complexities involved. The control risk, the client's internal control policies and procedures fail to detect and prevent material misstatement from happening. The errors and frauds are happening. So the maker-checker concepts may not be appropriately installed. Detection risk, auditor's failure to detect a material misstatement due to the nature of my verification or my other inherent procedures that are involved, or the time and the cost and the pressure that is involved in the audit, all this could lead to a detection risk here, or could componently call it as an audit risk here. So understanding the entity and its environment, if I do that appropriately, I will be in a better position to understand the inherent risk and control risk appropriately, so that I will also design the audit procedures appropriately, but thereby the detection risk can also be minimized here. So in one stroke, I will be in a position to reduce all the three components of audit risk. The moment I understand the entity and its environment, the inherent risk associated with that particular entity can be very much appreciated by the auditor. I will be going for a deeper verification on that. The moment I verify the internal controls of the entity, the controlled risk can be identified by the auditor, and then I may be performing audit procedures in such a way that those internal control failures can be brought down. And lastly, the moment I do this appropriately, my reduction risk can also have a effect, reduced effect will also be there in that regard. So coming back, KYC, knowledge about the client's business or know your customer, the relevant industry, regulatory and other external factors, including applicable financial reporting framework, has to be identified by the auditor. My dear friends, please understand, FRF is a very important concept at the time of accepting my audit. Financial reporting framework. What is the financial reporting framework applicable to this particular entity? The financial reporting framework applicable to that entity may be different from one entity to another entity. Usually, the financial reporting framework comprising of the accounting standards or Ind AS, as the case may be, the legal and regulatory requirements, including Companies Act requirement, and the generally accepted accounting principles and practices. All these three components will be part of my financial reporting framework. Say, for example, I am a listed company, then Companies Act will be applicable. My accounting standards will be applicable. Ind AS will be applicable. Then SEBI regulations will also be applicable here. I am parallelly an NBFC entity, then RBI regulations will also be applicable. I am an insurance company, then Insurance Act will also be applicable, then IRDA regulations will also be applicable. Like that, the legal and regulatory framework that are applicable to that particular entity will be based on the entity and its environment, the regulatory environment with which it operates. So a banking company, the regulations will be different. For a normal small private limited company, the regulations could be different, the requirements could be different. For a large corporate of a listed entity, the regulatory requirements could be different, the disclosure requirements could be different. So accordingly, the applicable financial reporting framework has to be evaluated by the auditor. That can be evaluated only based on the relevant industry, regulatory, and other external factors. Say, for example, there may be additional reporting responsibility to the auditor, like CARO reporting or a CAG specific reporting like that. There are multiple reporting that will be applicable to that entity here. The nature of the entity, including its operations, its ownership, including future plans. Again, that's a very, very, very valid consideration that is to be made by the auditor. What is the ownership structure? Is it a foreign subsidiary? Is it a particular entity with a regulated sector? Is it shares are publicly held? What is the future plans of that particular company? Say, for example, I am a foreign subsidiary and my entity's plan is to operate in India for 5 years and then to shut down my operations. My audit considerations will be absolutely different in that particular entity. So my going concern evaluation will be very much applicable every year, especially in the 5th year where I am intending to shut down my operations intentionally. So the regulatory environment, the ownership structure, the business components, including the business share of that particular company, the profitability of that company, and all will be part of important considerations to be made by the auditor here. The entity selection and application of their accounting policies vis-a-vis the regulatory framework and industry standards. So that what is the accounting policy with regard to revenue recognition, expenses recognition, like that. What is the industry benchmarking and all can be taken as a reference from by the auditor. The entity's objectives, strategies, and those related to businesses that may result in a risk of metal misstatement, or the technology that is used by the entity, which may be banned by the company, banned by the regulatory environment. In SA 570, when we are discussing about going concern indicators that could affect the going concern impact, there are multiple parameters with which you need to bucket it and then you need to evaluate it. Say, for example, financial parameters, operational parameters, regulatory parameters, like that, all will be having an effect on SA 315 read with SA 570 here. Technically speaking, this is also part of the study of the company, which is at the time of acceptance of the company, the auditor will be in a position to do that. And then I need to document this aspect also, which will be forming part of the permanent audit file of the auditor as a part of my documentation here. So that I need not do every year moment in the initial audit engagement as applicable to SA 510 when the auditor is in a position to do that and then document it in the permanent audit file. Every year I need to just go for an update and the latest developments and trends in this regard, and then can be updated in the documentation as well. The measurement and review of the entity's past financial performance, especially when modified reports in the previous year. My dear friends, this is a very important consideration that the auditor has to make it. When the financial statements of the entity in the previous years are having modified opinion, that means what does it denote? When there is a modified opinion means there are material misstatement in the financial statements which are not corrected by the management. That's why the auditor has given a modified opinion, either a qualified opinion or an adverse opinion or even a disclaimer of opinion that have been provided by the auditor. If the previous financials contains modified opinion, that itself indicates that the material misstatements are there in the financial statement, which is not corrected. So the effect of the same in the current year has to be looked into. The auditor has to consider the effect of SA 510, and also auditor has to go for discussing the same with the management for the correction and the further course of action in this regard. Otherwise, the current year also may be having a material misstatements effect here. The second and important criteria which is to be taken up by the auditor is with regard to the internal controls of the company. What is this internal controls? Four important objectives of internal control. Again, it is discussed in SA 315 only. Beautifully drafted. I always love this particular part. Four important aspects of internal controls. What four internal controls are? What is the objective of the internal control? The four objectives of internal controls are reliability in financial reporting, efficiency and effectiveness in the operations of the company, safeguarding the assets of the company, safeguarding the interest of the company, protecting the interest of the company, and last but not least, compliance with all applicable legal and regulatory requirements here. All these four are the responsibilities, primary responsibilities of the management. Management shall be responsible for design, implementation, and maintenance of internal controls, including internal financial controls with reference to financial statements. So the ultimate responsibility lies with the management, those charged with governance, but still the four objective has to be rightly addressed while designing this particular internal controls. Reliability in financial reporting, efficiency and effectiveness in my operations, safeguarding the assets of the company, compliances of all applicable laws and regulation. Whatever the laws and regulations that are applicable to that entity, it is the responsibility of the management to comply with that. So when laws and regulation has been discussed, SA 250, the auditor has also needs to go for a reference and needs to go for a comparison here, where as per SA 250 for the auditor, the SA suggests you divide the laws and regulations into two parts: laws that do have effect on the financial statements, laws that do not have direct effect on the financial statements. Like that, I can decide and then I can design my audit procedures accordingly. However, for the purpose of management, they cannot bifurcate into laws that do have a direct effect on the financial statements, laws that do not have direct effect on the financial statements, like that. Every law and regulations that are applicable will be mandatory for them to comply with. They have to design their internal controls in such a way that all the legal and regulatory requirements have been taken care while the internal controls are operating for that entity here. So this particular internal controls cannot be just like that implemented by the management. They need to perform RAP, risk assessment procedures, has to be performed by the management. Risk assessment procedures, what are the various risks that are associated, including at the assertions level and also at the financial statement level, so that including the business related risk has to be identified and assessed by the management, and then they need to have this internal controls design. So there are something called as a significant risk, which could influence and which could be material effect also. So there are normal risk assessment procedures and process that is to be performed by the management. The RAP are to be performed by two parties. One is by the management at the time of design, implementation, and maintenance. And the other one is by the auditor at the time of evaluating the internal controls. Understand, my internal controls again will be changing from entity to entity based on the size and complexities and the manner with which I am operating here. It is based on risk assessment procedure. The internal controls in a banking company will be different as that of the internal controls in a jewelry company. In a jewelry shop, my internal controls can be different. In a banking company, my internal controls will be different. In a manufacturing organization, my internal controls will be different. In a service organization, my internal controls will be different. So the management at the time of implementing this particular internal controls has to perform this particular risk assessment procedures. What are all the various risks, so that my risk can be addressed accordingly, and appropriately I need to design my internal controls. Please understand, RAP is like measurement before stitching a shirt. I want to stitch a shirt. Without measurement, just like that, a shirt has been stitched, then it will not fit in a particular case. So I need to do the measurement and then stitch the shirt so that it will be fitting to the particular person appropriately. Similarly, risk assessment procedure is a measurement that is to be done by the management that will be applicable to that particular entity, and accordingly they need to design the internal controls here. This is how the schematic objective of SA 315 is discussed about. First, I need to understand the entity and its environment, including its internal control. Thereby, I will be identifying and assessing the risk of material misstatement, which could be either through fraud or through error. And then it could be again at financial statement level, or at the assertions level, at the transaction level, or at the disclosures level. The moment I identify the same, design and implement responses to the assessed risk. This is as per SA 330. Once SA 315 job is done, immediately SA 330 and 500 series will start functioning about, and then I need to go and run to design and implement appropriate responses to the assessed risk so that I will be reducing the auditors to an acceptable low level. It is very beautifully and thematically designed, the SA 315, which is considered to be the spine of all the standards on auditing here. The process of risk assessment procedure is also discussed here in SA 315 itself. Like, I will be making inquiries with the management, I will be performing observation and inspections, and internal audit functions can be evaluated whether it is effective, whether they are independent, whether internal auditors are directly reporting to the audit committee, whether they are independent in functioning, whether their scope and objective is aligned with the requirements of the internal controls. Like that, the auditor will be performing various procedures, audit procedures, so that they will be in a position to evaluate the risk assessment process appropriately here. Those charged with governance and management are the top layer with whom the auditor will be having a discussion to understand the environment with which the financial statements are prepared. What is the entity's environment? What is the policy? What is the vision, so that their internal control policies have been installed? And with the employees level, the next level with which they are also operating at the top management level and the employees level, the auditor may be in a position to evaluate based on the appropriateness of the selection and application of their accounting policies and procedures here. What is the accounting policy that you adopt? Whether is it as per accounting standards or not? Is it as per relevant industry standards or not? Like that, the auditor may be in a position to have a inquiry, so that it can also be documented, which will be a part of my working paper here. With the marketing personnel, I may be in a position to understand the business risk associated with that entity, including regulatory requirement and market expectation and the company's performance. And very importantly, in-house legal counsel also, I may be in a position to discuss with regard to the various litigation that are applicable to that entity and its effect on the financial statements. SA 501 specifically talks about this aspect of litigations and claims relating to a particular company, where there are huge unrecorded potential liabilities could also be there, which may not be detected by the auditor in the normal course of their verification. So the litigation relating to the company and the position of the company's outcome and all will be a very important part to be examined by the auditor. Multiple reporting requirements, including Companies Act reporting requirements, CARO reporting requirements and all, there for the auditor to go for considering this particular aspect of 501 here. As a part of risk assessment procedure, the auditor shall also be performing analytical procedures. Analytical procedures are exclusively discussed in SA 520, which talks about various methodologies that are performed by the auditor, including ratio analysis and key trend analysis, budget analysis by the auditor, so that significant fluctuation can be immediately identified by the auditor. The moment significant fluctuation is identified, the possibility of material misstatement is very high in that. That doesn't mean there is a significant fluctuation means materially misstated like that. No. But it is an indicator. The auditor may be in a position to detect that material misstatement easily by way of an analytical procedure here. Technically speaking, as per SA 520, the plausible relationship between financial and non-financial data, and then interpolating the same and then concluding a results based on that will be part of analytical procedures that will be identified by the auditor. Very importantly, unusual transaction or significant change in that particular transaction can be easily spotted by the auditor the moment you do a analytical procedure or a ratio analysis or a comparative analysis, as the case may be, which is a usually very important tool that the auditor will be performing as a part of my audit procedure here. With regard to smaller entity, sir, every standard are also giving certain relaxation for smaller and less complex entities. It is not that all the processes that are applicable to a larger enterprise will be equally applicable to smaller and less complex entities like that. No, there are a lot of relaxation and scalability has been provided in the standards on auditing itself for a lesser consideration for a smaller and less complex entities. Like small audits may be carried out by the engagement partner itself, or not by team and all, like a sole proprietor, or he will be responsible for considering the susceptibility of the financial statements of fraud and error. There will not be sophisticated tools, may not be available. Internal control process may not be that much more process oriented and all, because it is a smaller and less complex entity. One owner manager by itself will be doing all this. So you don't have a maker checker concept and all as applicable to all other entities, may not be there also. In that particular case, whatever that are applicable, which are relevant, may be considered and can be documented by the auditor for smaller and less complex entities as well. So the industry regulatory aspects, financial performance of that particular company, the accounting policies and its applicability with regard to the accounting standards, its consonance with the accounting standards, the nature of the entity and all will be part of very important consideration that the auditor has to specifically document also. Not only as a part of SA 315, but also as a part of SA 210 with regard to agreeing the terms of engagement. This will be a part of my documentation that will help the auditor to do the audit appropriately here. These are all certain specific consideration to be included in the evaluation and documentation here. What is the market competition? What is the cyclical seasonal activity that are applicable to that entity? Say, for example, I am an auditor of a sugar industry, sugar manufacturer. It is again based on seasonal activity. My production may be for 6 months and balance 6 months may not be there for my active functioning. I may be, the company may be involved in certain maintenance activities, or can go for an alternative products and then do related chemical related products and all. So how your activities are coined and what is the manner with which the production is going to happen, the production technology, what is the energy consumption cost and supply chain management and all will be part of the industry function evaluation. The regulatory requirements, including the accounting principles, regulatory framework, government policies for the product that is dealt by the company. Say, for example, hazardous items, the pollution control items, its effect on the financial statements, the adverse orders by the regulators on the going concern of the entity, like that. There are multiple factors that the auditor has to keep on study, keep on parallelly document, keep on consider the same while performing the audit with regard to my audit procedures. There is something called as NTE, nature, timing, and extent of audit procedures. The nature, timing, and extent of audit procedure is specifically discussed in SA 300 that talks about audit planning, where considering the entity and its environment, I need to go for designing by planning. I need to design complexities. I need to go for nature, timing, and extent of audit procedure has to be developed by the auditor here. The method of accounting, including identification of unusual transaction, thereby a deeper verification can be performed by the auditor. The effect of accounting policies and including the emerging areas where there are possibilities of material misstatement will be high. Say, for example, technology. Completely my process is driven through the automated processing. There is a high possibility of material misstatements. There is a high possibility of internal control lapses or frauds that could also be there. The auditor has to gear it up accordingly. Changes in accounting policies, financial reporting standards, or advancements or amendments to the standards and regulatory requirements and all are part of your study and its implementation here. The factors always to be considered by the auditor with regard to understanding the material effect, the assessing the risk of material misstatement and its effect will be predominantly on the materiality factor, the significance of related risk, all are judgment of the auditor. That's why the auditor's experience will play a very, very vital role here. That's why it is told that it is a constant factor. Auditor's judgment will be a constant factor to be applied. The materiality consideration, the significance of the related risk, the size of the entity, or the nature of the entity's business consideration, like that. There are multiple factors and parameters to be looked into by the auditor, parallelly to be documenting. Say, for example, in a particular company, I may not think that this is an relevant one. I might have ignored that also. Purposefully, intentionally, the auditor may be dropped it considering it is not material. But if I don't document the same to a third party or by enabling an experienced auditor criteria, when in the absence of documentation, it will be treated that as if it is a mistake or an erroneous committed by the auditor here. So the documentation of whatever the various considerations that are made by the auditor, especially with regard to analysis of the significance of risk of metal misstatement, will be of great help to the auditor here. The nature and extent of understanding of the controls relevant to the audit, including the internal controls. We will be going for internal control evaluation shortly, which is considered to be the key of SA 315 here. There are 5 components of internal control evaluation. 5 components of internal controls. In spite of the fact that, as I told you earlier, I am not the internal auditor, still, as a statutory auditor, including for the purpose of reporting on the internal financial controls with reference to financial statements, not only for that particular purpose, but also for my audit risk, control risk purpose, the auditor has to necessarily study the internal control systems of that organization. Technically, as per SA 315, it is divided as 5 components, pancharatnas, that the auditor has to look into. 5 internal control evaluation that the auditor has to make. In spite of the fact that the management has designed and implemented their internal controls, these 5 components are to be specifically looked at by the auditor and document the same so that its efficiency and efficacy can be evaluated by the auditor with reference to the financial statements and the material misstatements in the financial statements. The 5 components are: number 1, control environment, REAP performed by the management, information systems and its effect on the operations of the company, the relevant internal controls that are designed and implemented actually by the company, and lastly, control monitoring process, whether it is appropriately done or not. All 5 components are a specific aspect that is to be looked into by the auditor. What is this control environment? This is start from the top, the tone at the top. The control environment is the attitude and the behavior and the culture that are set up by the top level management, including those charged with governance, the audit committee, etc. Where the culture of the company by itself is to have internal controls and explicitly comply with internal control requirements. Obviously, the same trend can be there throughout the pipeline. Throughout the company's operation, you will have that ethics and ethos that are reflected in the company's operations with internal controls. On the other hand, the top level management by itself is not interested or not showing interest on this ethical behavior or control environment, then the same sort of weaknesses or the lapses or lack in internal controls will always be there in the complete process here. So the control environment, the attitude and the behavior of the top level management, and they are emphasizing significance of this particular internal controls will be studied by the auditor. If it is yes, if it is there, then predominantly the policies and procedures will be oriented towards that. There will be a separate committee of the management which will be working on this like that. It is again based on the company's size and complexities here, attitudes of the management and the ethical behavior of those charged with governance, which will have an effect on the complete operations at the all levels here. This is on the first component evaluation. The second component evaluation is the REAP by the management, whether management has done the REAP appropriately. It is again risk-based evaluation are also happening. Like risk-based internal audit today, it is more famous. Similarly, risk-based assessment also by the management will be evaluating here. They will be doing like identifying the total business risks that are associated in that particular entity, and then estimating its significance and estimates its likelihood of happening here, and then take appropriate action. There is something called as risk matrix. This is usually based on the risk appetite and the risk management policies of the company. They will be having this particular sort of risk matrix. Like all the risk can be charted down, and then management will be in a position to segregate. These risks are highly probable. If it is happening, the effect will be very high. This risk are low, this risk are medium, like that. They will be categorizing it, and then they will be bucketing into unacceptable extreme risk, unacceptable high risk, moderate risk, and low risk here. So the auditor will be trying to reduce it to an acceptable low level is this particular C curve, that is LLL, the low risk, where the action by the management will not be for all the risk associated, risk management policy has to effectively work on like transfer, substitute the risk like that, alternate the risk like that. They will be working out, but they will be first focusing on the extremely high risk, so that they will try to address it and then reduce it to a next level. And then unacceptable high risk will be worked out, and then they will be pulled down to medium risk. And then medium risk, they will be further pulled down to acceptable low risk. This is also called as residuary risk. So the moment the risk are there within the acceptable level, no problem, I can even continue with that particular risk like that. The risk assessment procedures has to be performed by the management. And if RAP has been performed and internal controls has been established, it will be really effective. On the other hand, if it is not, then it will be a problem for the auditor also for this. The third component of internal control evaluation will be information systems and the effect of automation. The moment internal controls are through automated environment, predominantly the focus will be by the auditor will be on the controls, checks and balances. If the controls are appropriate, I need not bother about the outcome. It will be automatically taken care. On the other hand, if the control or the design of this particular automated environment by itself is flawful or there are problem, then it will have a serious effect on the financial statements here. Like there are benefits and demerits of manual as well as automated systems here, benefits of automated controls. Risk in an automated control is also there. The auditor has to evaluate and then needs to go for it, even though there are more automated controls that can be performed. The auditor may even take the help of an expert, auditor's expert, to evaluate the automation, the technology that is adopted, the controls that are embedded in those particular technology can be evaluated through the auditor's expert here. Or even management's expert as per SA 500 can also be taken and then may be treated as an audit evidence here. The fourth point with regard to internal control evaluation, component of internal control evaluation, is whether relevant internal controls has been established first of all. Again, it is based on the policy that is drafted at the top level. These are all the implementable internal controls. For that, whatever the physical as well as tangible, intangible assets to be deployed and the process to be implemented, whether it has been implemented or not, shall be examined by the auditor here. Internal control activities are those policies and procedures maintained to ensure that the management directives are carried out. Management may have a directive, but if it is not implemented, then it is of no use. So whatever the management's directives have been implemented in the manner with which it is expected will be an appropriate internal control here, like segregation of duties, maker-checker concept, internal control evaluation by appropriate or periodical examination of the internal audit. Like that, there will be a part of internal controls here. Internal check can also be there as a part of internal controls. And lastly, control monitoring here. Control monitoring is another important aspect here. Not only your internal controls to be implemented, design, implement and maintain is what a important aspect. Unless the internal controls are monitored, it may become ineffective here. So monitoring over a time or a particular intervals or by evaluation of the patches will be a very important aspect that is to be taken care by the management, and whether management is appropriately doing it or not shall be examined by the auditor also. Internal audit reviews through external reports or customer complaints, direct review by the owner manager in case of a smaller and less complex entities like that. Sorry, the auditor will be in a position to evaluate the monitoring perspective. Also 5 internal control evaluation here. And comes to the documentation part. Right from the beginning, whatever the aspects that are performed by the auditor as a part of understanding the entity and its environment, including its internal control evaluation, has to be periodically, as and when the audit is performed, the auditor has to document. Very importantly, I need to engage my engagement team. My audit engagement team has to be sensitized with regard to the importance of this particular documentation. My key engagement team members are relevant people for this particular documentation. Owner manager may not be, or audit manager may not be in a position to document everything. It is the performance level, that the core level at the team who is at the grassroots level, they are performing the functions. they need to go for this particular documentation here. Discussion among the engagement team and significant decisions reached, including the conclusions made or the queries raised and the answers that are obtained, and its satisfaction completion should be documented. Key elements of understanding the entity and its environment, how the risk has been addressed by the audit, what are all the see, the moment I have identified these are all the significant risks, then what is the next course of action? That is, application of SA 330 and 500 series are to be parallelly documented, so that that is not a open-ended loop that is dealt. Form and extent of audit documentation that will be depending on the nature, size, and complexities of the internal controls, availability of the information, management's intention to share with the information, like that. There are multiple perspectives here. In this regard, I would also like to draw the reference of Section 134 of the Companies Act. Please understand, even though it is not part of SA 315, there are related points for the statutory auditor to look at. As per 134 of the Companies Act, the board's report shall contain the following: financial summary highlights, change in the nature of the business, details of directors and KMPs, names of the companies which have become or ceased to be the subsidiaries and joint or associate entities, details relating to compliance and non-compliance of deposits. Again, it is a regulatory requirement. Significant and material orders passed by the regulators and courts. See, why I am linking here is all are in one way or another. It is linked with our SA 315 and also the auditor's responsibilities for reporting as well. Details in respect of adequacy of internal financial controls with reference to financial statements and all. This aspect that we have specifically looked at. Based on the outcome of the risk assessment procedure, there may be possibility of revision of risk assessment also. Say, for example, I originally thought that this will be a simple exercise or an activity, but during the course of my risk assessment procedure, I identified there are a lot of weakness. The internal controls are not operating effectively in this particular regard. So this position generates a inconsistency with regard to my audit evidence. I would have already obtained an audit evidence differently, but now because of the updated process that I have a different audit evidence, then I need to resolve the conflict by extending my audit procedure as per SA 500 here. There are modified audit procedures that I need to apply, alternative audit procedures also to be taken up and then to be documented here. The documentation specifically depends upon the nature, size, and complexities of the entity. It cannot be a single documentation that will be applicable for all. No, it cannot be like that. It will be again based on the complexities here. The audit methodologies that are performed, including the technology that is used in the audit here, including audit softwares that can be used by the auditor here. Obtain sufficient appropriate audit evidence which enables the auditor to form an appropriate audit opinion and document the significant audit procedures performed, significant findings along with conclusions drawn. Sometimes based on the significant findings, including internal controls weaknesses that are identified by the auditor, there may be additional requirements for me to communicate with those charged with governance also. Say, for example, significant difficulties faced by the auditor or significant internal control deficiencies faced by the auditor are to be communicated to the management and those charged with governance as per SA 260, SA 265 also. Key audit matter to be communicated as per SA 701 also. So all these are all part and parcel of the audit process and the communication requirements, including the documentation requirements to be taken care by the auditor here. The moment SA 315 is done appropriately, 330 is a subsequent offshoot. 330 more procedural process has been discussed in this particular essay. I would like to go with more practical analysis, especially relating to 500 series of essays here. Even though 330 specifically talks about auditors' responses to the assessed risk. Unless I assess the risk, I cannot make responses. So mandately SA 315 has to be performed. The moment SA 315 perform, I will be in a position to identify the material misstatements. I will be in a position to identify the effect of risk of material misstatement. Thereby, the auditors can also be identified by the auditor. To reduce it, I need to make responses. So how to make that particular responses? Let us go for the scope of this particular SA 330 here. The auditor's responsibility is to design and implement responses to the risk of material misstatement identified and assessed in accordance with SA 315. So obviously, SA 330 is a byproduct of SA 315. I cannot omit any of SA 315 or SA 330 as the case may be here. It is the responsibility of the auditor. It is not out of my sophistication I am doing it. It is a mandatory requirement for the auditor to do it. That's why we are in a position to mandatory to comply with that. Again, SA 330's objective is to obtain sufficient appropriate evidence. Audit evidence has to be taken up. Sufficient and appropriate audit evidence about the assessed risk of material misstatement has to be taken up. The sufficiency and appropriateness in audit evidence will be again based on SA 500 series, including the judgment of the auditor. What do you mean by sufficient? What do you mean by appropriate? Sufficiency talks about the quantity and appropriateness talks about the quality of the audit evidences here. There are rules of reliability as per SA 500 that talks about which audit evidence can be relied, which audit evidence can be relevant to one particular audit. Please understand, in an audit, as per SA 500, whatever you hear is an audit evidence. Inquiries, I just discuss, I hear, it will be an audit evidence. Whatever I see is an audit evidence. I go for a physical verification, I observe something, and then I see something, it will be an audit evidence. Whatever you verify through documentation is an audit evidence. There are vouchers, there are documents, there are ledgers. I go through that, which will be an audit evidence. So whatever you see, whatever you hear, whatever you perform, whatever you verify, everything will be an audit evidence. But there are something called as relevance and reliability. Which one can be relevant? Which one can be reliable? Accordingly, I need to go and take that particular relevant and reliable audit evidences and then to document it and then to make that as an audit evidence which will enable me to form an opinion. Please understand, the audit evidences, first of all, should enable you to conclude. Unless you conclude, you cannot be in a position to express that particular opinion here. So that's why sufficiency and appropriateness in audit evidence is a very important factor to conclude with your opinion matrix. SA 700 read with SA 705 talks about how your opinions can be given, whether it can be a clean, whether it can be a modified. If it is a modified, when to go for a qualified, when to go for adverse, when to go for disclaimer, like that. There are multiple scenarios that are discussed exclusively in SA 705 and 700. In all these probabilities, in all these different situations, the sufficiency and appropriateness with regard to the audit evidence play a very crucial role. If sufficient appropriate audit evidence is there, then what is the consideration? If sufficient appropriate audit evidence is not there, then what is the consideration? Like that, it will be absolutely dependent on the sufficiency and appropriateness with regard to the audit evidence. So that sufficiency and appropriateness in audit evidence, as I told you earlier, plays a very vital role with regard to reducing an audit risk to an acceptable low level here. So the auditor needs to carefully design the responses to the assessed risk. It is like a doctor prescribing medication for a problem. Similarly, auditor has to prescribe the medication for the assessed risk by way of a responses, whether I need to shrink my audit procedure, whether should I need to extend my audit procedure, what is the nature, timing, and extent of audit procedures to be performed. This particular area, the risk of material misstatement is low. This particular area, the risk of material misstatement is high. I need to go for a deeper verification. I have already identified internal control deficiencies. In that particular regard, I need to extend my audit procedure. Like that, there are multiple considerations to be taken up by the auditor while performing the audit, while the different scenarios are being encountered by the auditor here. Through designing and implementing appropriate responses to the audit risk, the auditor has to go as a responses to the assessed risk here. Substantive procedures and compliance procedures. There are two types of audit procedures that can be performed, including risk assessment procedures, 3, technically speaking. The substantive procedures are also called as test of details. It moves with regard to the numbers. It moves with regard to the validations, with regard to the assertions. It moves with regard to the disclosure perspective, like that. It more on the number accuracy and the validity for that particular disclosures here. On the other hand, with regard to the compliance procedures, which is also called as test of controls, more of internal control verification, more of the maker checker concepts, more of the micro level with regard to the policies implementation and the process implementation shall be examined by the auditor here. The overall responses based on the assessed risk specifically involves emphasizing on professional skepticism. As I told you earlier, the constant factor, professional judgment and professional skepticism is this particular aspect here. Taking reasonable care and caution. The responsibility of the auditor as per SA 200 is to perform the audit with all due diligence in order to perform my audit with all reasonable care and caution. How to prove that I have taken reasonable care and caution while doing an audit? It is nothing but establishing professional skepticism. I emphasize on the professional skepticism, that is nothing but having a questioning mind, being alert to conditions that could indicate possibilities of misstatements through errors and frauds, and critical assessment of my own audit evidences. Is it sufficient, appropriate? Accordingly, the auditor may be in a position to prove that he has taken all reasonable care and caution here. Professional skepticism is an important factor to be documented and also to be established here. Assigning more experienced and skilled staff or experts so that in that particular area, say for example, it is a problematic area or more possibilities of material misstatements, already it is prone, it is like an accident prone zone. Go slow, or there are reflectors, or there are speed breakers. So the moment the risk is identified, immediately more experienced and expert related staff or engagement team will be employed by the auditor so that it is reasonably handled appropriately here. More supervision, more follow-up, more documentation, more management's representation in that particular regard. Repeated queries and then the solving of the same has to be documented. General changes to the nature, timing and extent of audit procedures will be performed here. Nature, timing and extent. What is this technically nature, timing and extent all about? Say for example, I just give a layman's experience so that it can be absolutely related in audit terms. I'm an auditor of Hyundai Motors where I want to verify the closing stock. What is how I will be performing the verification? I will be performing physical verification of closing stock cars. Very good. The physical verification should be performed as on 31st March 2025, the closure date of financial statement, or 31st May 2025, which is the audit report date. When I need to perform the physical verification? Physical verification should be performed on 31st March. That is the closure date. Very good. I have 20 number of cars closing stock. How many cars that I need to verify? Should I need to go for a sample verification? Should I need to go for 100% of verification? I will verify 20 cars, all 20 cars, 100% in this regard. Assuming I have 2000 cars in various locations, stock locations, then in that particular case, based on materiality and based on other factors, the auditor may decide how it can be verified. Exactly what we are discussing about is nature, timing, and extent of verification. Here, the nature of verification is physical verification. The timing, when it has to be performed, is the timing of verification. To what extent it is to be performed? Should it be 100%? Should it be 10%? Should it be 50%? Like that, it will be dependent upon the complexities and the size that is involved, including the materiality that is involved. The risk of material misstatements that is identified in that particular area is involved. Like that, it is a very variable factor, the nature, timing, and extent of audit procedure. The basis of which the nature, timing, and extent of audit procedure is to be determined by the auditor, has to be documented, and then that will be substantiating the role played by the auditor, judgment played by the auditor while deciding the course of action here. Especially when there is a weakness in internal control. Sir, we need to take the clue from SA 450 that talks about the material misstatements that are identified during the audit. When the misstatements that are identified during the audit is clearly trivial, I can ignore. On the other hand, if it is material, I need to immediately extend my audit procedures. Also, I need to communicate to the management because your internal controls are so weak that permits material misstatements to happen. So I need to communicate to the management, and then I need to ensure that the management corrects that particular material misstatement. If management has corrected that misstatement, then no problem. I need to document and close it. On the other hand, if the management is unwilling to correct it, that particular material misstatement, then it will be treated as uncorrected material misstatement. The uncorrected material misstatement, the effect has to be evaluated by the auditor. Is it material considering the financial statement as a whole? If it is yes, I cannot go for a clean opinion. I need to necessarily go for a modified opinion. On the other hand, the effect of uncorrected material misstatement is not material considering the financial statement as a whole. Then I may be in a position to drop that particular point also. So it is again based on the decisions of the auditor, judgment of the auditor. Why this particular point is discussed? Because weakness in internal control, the moment there are weakness in internal control, it is a matter of concern to be communicated to the management to take appropriate action in this regard. And auditor also needs to extend the audit procedures performed here. Like that, I need to have a questioning mind whether test of controls alone will be sufficient, whether substantive procedures should also be performed, or a combination of test of controls and test of details to be performed. Like that, I need to go for a alternative methodology here. The nature, timing, and extent of audit procedure, just now we have discussed here, the purpose and the type of procedure, the timing with which when it is to be performed. At times, as per SA 501, with regard to physical verification of inventories, they say it is always better to go at the 31st March, which is the closure of the financial statement date. In remote possible, where the auditor is unable to participate, no problem, you perform on an alternative day, but do a reconciliation of the transactions between the closure date and the date on which your physical verification has been performed. Like that, there are timing aspect is also discussed here. The extent with which the verification has to be performed, I need to be in a position to have a matching concept here. I would like to insist upon the importance of 500 series of essays, in spite of the fact that we are confining only to essay 315 and 330. My dear friends, you cannot read 330 without 500 series here. Because specifically 500 series of essays talks about a different methodology with which audit evidence can be obtained, which is nothing but a responses to the assessed risk only. Say, for example, specific consideration as per SA 501 in case of litigations, in case of inventory, in case of segment reporting is exclusively discussed with regard to SA 501. 505 with regard to external confirmations, including bank confirmation, bank certificates and all, external confirmation from parties, where you have positive confirmation request, negative confirmation request and all. 510 specific procedures relating to initial audit engagements, being the first time that I am going to do the audit of this particular entity, how I need to consider the effect of the opening balances, the misstatements in the previous financials. Like that, there are specific considerations that is to be made by the auditor as per SA 510. 520 talks about analytical procedures. Sometime back that we have discussed relating to ratio analysis and trend analysis, the plausible relationship between financial and non-financial data here. And very importantly, SA 530, audit sampling. Predominantly in all the audits, we will be performing this particular essay, but we may not be in a position to document how we have performed the sampling. Specifically, when sampling has been performed, whether it may be judgmental or it may be statistical purposes, the auditor has to document the basis of sample that is taken from the population and the manner with which the population has been examined, and then how the conclusions have been drawn with regard to the entire population has to be documented here. 530. 540, which is on estimates, which is again related to the inherent risk associated with the company here. There are a lot of estimates and its evaluation, especially with regard to fair value estimations and all. 550, most important related party transactions, where there are identification of related party transactions, accounting and disclosures of the related party transactions will be a part to be done. Essay 560, another beautiful essay, subsequent events, where I have submitted my audit report, which is not circulated, but I come to know a particular information. Had I come to know about this particular information beforehand, I would have gone for a difference in audit opinion, or the financials accounts could have been changed. Then what is the course available? If it has been circulated to shareholders, what is the course that is available? Like that, the aspect of dual dating is all discussed in this particular essay. Beautiful essay. 570, most important essay, going concern. It is actually revised essay here with a lot of new consideration, especially after COVID. there are specific guidance that are given by the WASB with regard to going concern and its effect, the assessment by the management and the auditor's assessment on the management's assessment like that. SA 570 will be another important factor to be considered. 580 with regard to written representations, a mandatory one where the auditor has to go and obtain written representation from the appropriate level of management about including the assertions and various aspects relating to the financial statements here. So if we perform the 500 series of audits or 500 series of methodologies as stipulated by the standards, automatically it is a compliance of SA 330 here. Sufficient appropriate audit evidence, what information to be used as an audit evidence, how to select an item for testing, whether is it through sampling or is it 100% or specific selection, and in case of inconsistencies between one audit evidence and another audit evidence, how it is to be resolved. Very importantly, these are all the methodologies that are stipulated in SA 500 itself, like you go for inspection, you perform inquiry, you do the observation, you do recalculation, re-performance, you obtain written representation, you perform external confirmation, you do analytical procedures and all, are the different methodologies with which audit evidence can be obtained. Very importantly, as I told you something about rules of reliability sometime back, these are all the 5 rules of reliability specifically enshrined in SA 500 here. External evidences are more reliable than internally generated audit evidences. That doesn't mean internal evidences are not reliable. Internal evidences are also reliable if internal controls are effective. That's why internal control study should be made by the auditor to rely upon the internally generated audit evidences as well. Audit evidences which is more reliable when it exists in a documentary form rather than other form. So whatever you hear, whatever you see, whatever you verify, out of which whatever that is in a documentary form are more reliable than any other form. Original documents are more reliable than photocopies or scanned copies like that. And very importantly, lastly, evidences obtained directly by the auditor are more reliable than obtained through other source or through outsourced methodology here. So technically, I need to apply the rules of reliability with regard to evaluating the sufficiency and appropriateness in audit evidence so that I have appropriate conclusions and it can be reported as per the standards here. With regard to smaller entity consideration as a specific practical part, not many control activity exists in a smaller entity or less complex entities. The extents of documentation will be limited. To that extent, whatever that are applicable, you do the documentation. Substantive procedures performed and obtaining how sufficient appropriate audit evidence has been established can be documented here. Evaluate whether overall presentation of financial statements, including related disclosures, is in accordance with applicable financial reporting framework, because disclosure also forming part of material misstatements in the financial statements here. Because material misstatement may be because of inadequate, inappropriate accounting or inconsistency in application of such accounting policy, or even inadequate disclosures could be resulting in material misstatements here. The sufficiency and appropriateness in audit evidence, if it is not there, I need to either go for a qualified or disclaimer of opinion accordingly. Even adverse opinion not to provide, I need to have sufficient appropriate audit evidence to say that there are material misstatements that are having pervasive in nature as per SA 705 here. Specific documentation here. I would like to insist upon the specific documentation of linkage of those process and procedures that are performed by the auditor to make the assessment here. So the assessment is performed like this, and this is what the assessed risk, and this is how I have made the responses like that. If at all there is a linkage that is available between what is verified and what extent it is to be performed and what is the outcome, will be really helpful for the auditor to prove the enabling auditor criteria as per SA 230 here. Demonstration that financial statements agree with the underlying accounting records will be a matter of judgment of the auditor here. The audit documentation has to be retained for a minimum period of 7 years from the date of audit report. So I need to have the working papers all appropriately done here. These are all certain very useful references that I thought I need to share it to the people so that it will be helpful for you. Useful reference materials from ICAI, Practitioner's Guide to Audit of Small Entities, where small and medium practitioners may be having a very less complex entities to do the verification. So this particular guidance by WASB is very helpful, and it is having beautiful compilation of relevant material here. Specifically, implementation guide to SA 230 audit documentation, that is an institute publication here, WASB, a beautiful resource with a lot of checklists that are available how to go for a documentation here. And also there is a e-booklet on sample checklist on standards on auditing, a ready reference for practitioners and CA firms. So a compilation of a comprehensive compilation that is made by the WASB here again. It is a beautiful resource, so people may be in a position to use it. Also, the CAQ, the Center for Audit Quality, has brought out certain beautiful tools for determining the materiality, tools for determining on the engagement letters, automatic generation, Excel tools are there. And there are Excel tools with regard to the standards on auditing application, branch audit tools like that. There are multiple tools that are brought in by CAQ also, which are all freely available at our CAQ website and WASB website also. People may be in a position to make use of that particular material and ensure this particular standards on auditing are completely complied while discharging this particular attest function here. I think we are exactly on time, and I thank WASB for making this wonderful evening, a webinar comparing very important standards, SA 315 and 330, read with SA 500 related series, for having a practical discussion with people here. I feel privileged to be part of this knowledge initiative of WASB. Thanks to the office bearers and all the officials who are involved in this particular process, and also thank the participants from this particular webinar who are, in spite of their busy time schedule, out of 15th September fastly approaching, where people are in a position to participate in very large numbers, and thanks for you as well. And this is my contact details, and I will be in a position to have your queries over mail or through WhatsApp. We'll be happy to respond wherever that is possible here. And over to Vivek sir for the final remarks. If at all there are any specific questions that is to be addressed, I will be happy to address it here.
Thank you, sir, for sharing such a valuable insights on two important essays like SA 315 and SA 330. And sir, today in today's session, we have joined by more than 800 members, and we have received some. We have also received one or two queries from the members related to SA 315. So I request you to please take these questions for the members.
Yeah. Could you share that
first,
particular question? Or you read the question so that I can.
Sir, I will read the question and also put the questions in chat box, so you can also refer these questions from there. So the first question is related to is the most critical in the current scenario is external risk and human risk, which are very, very moving and dynamic part. What are the new emerging techniques to assess these as well as review? Like,
No, unable to get the question properly. Sorry, can you repeat it? Yeah, I'm reading it. The most critical in the current scenario is external risk or human risk, which are moving very dynamic parts. Okay. What are the new emerging techniques to assess this as well review here? It's very, very relevant question made by the learned member here. External risks and human risks. Sir, one part that as an auditor, we are very clear on this, because these are all very dynamic, as you are talking about. On a daily basis, there are businesses that could be associated to the company, maybe in technology, maybe by the competitor, or maybe in regulatory front, and also the human risk who are involved in the company, maybe as an employee or as a supplier or as a procurement or as a borrower, like that. There are multiple factors are there, sir. Technically speaking, sir, as per standards on auditing, it is not the responsibility of the auditor to analyze and to be abreast about all these particular risk here. Because as an auditor, my responsibility is confined only to financial statements and the material misstatements relating to the financial statements and audit risk. As a part of the process, I incidentally read all other risk as well. But my focus will be mainly on the internal controls and on the deduction risk, that is on my own audit performance, rather than this particular evaluation, which will be no end. It is infinite, is got the timeline. So it may not be appropriate for the auditor to spend much time on that particular aspect. maybe a representation from the management will be helpful. That doesn't mean that I need to close my eyes on this particular area. As a part of my SA 315 compliance itself, this particular aspect will be addressed, and it is not the responsibility of the auditor to completely look into and have a deep dive into this particular business risk and human related risk as a matter of auditor here. That is maybe a little bit out of the scope of the auditor here. Hope this answers the position.
And so the next question is, if an entity recently changed its business model, then what are the procedure under SA 315 should an auditor should follow?
Sir, again, there is no specific requirement like when the entity changes the business model, what I need to perform like that, it is not there. Again, it is the judgment of the auditor. I need to go for it. There are business diversification that the company may be going for it, but I need to, as a process of understanding the entity, including its regulatory requirement, a relevant compiling requirement or a compliance requirement or a reporting requirement, what could be the effect has to be read by the auditor, and that takes care of it. There is no specific process or specific procedure that you need to do all this like that. There is no such conditions or requirements that is imposed by the standard here.
Okay, sir. Sir, 2 questions we have received from the members, and thank you, sir, for taking these questions. And I also thank you all the participants for such a interactive session, for
Very nice.
engaging, for their engagement. Thank you, sir.
Very nice. Thanks to the entire WASB team and Vivek, and including the technical team and all the member participants. Thanks for the great opportunity. Thank you.
Thank you, sir.